In 2022, renowned investor Dr. Michael Burry issued a series of ominous warnings and bleak predictions. The year proved to be challenging for many, as the Federal Reserve's response to 40-year high inflation negatively impacted the overall economy and equity market. Michael Burry is a renowned investor who gained fame after his successful prediction of the 2008 housing market crash, so we can't completely write off his predictions. The man knows what he's talking about. Now, he's predicting that a recession is coming in 2023. This prediction comes as a shock to many, as the US economy is currently experiencing a period of relative stability and growth. However, Burry is a highly respected investor, and his predictions should not be taken lightly. His prediction is causing many to take a closer look at the state of the US economy and to consider the potential causes and signs of an impending recession. With Burry's prediction, there is a growing sense of urgency to take action to prepare for a potential economic downturn. We take a look at Burry's prediction in greater detail, as well as the potential causes and signs of a recession. Burry's prediction of a recession in 2023 is based on his belief that the Federal Reserve will continue to raise interest rates. Burry believes that this increase in interest rates will lead to a correction in the stock market and will eventually lead to a recession. As the new year began, Burry appeared on Twitter with his dire prediction for 2023. He not only warned of a potential market crash and recession, but also revamped his stock portfolio. With the start of 2023, the flow of economic outlooks is in full swing. Many institutions such as Bank of America and JP Morgan have expressed concerns over the economic outlook for the year. Bank of America warns that the US economy could lose 175,000 jobs per month during Q1 of 2023, expecting a harder landing rather than a softer one. Similarly, JP Morgan predicts that the US could enter a mild recession by the end of next year, as higher interest rates slow demand for goods, services, and the workers to produce them. The International Monetary Fund has also called the rising interest rates a major cause of a steep fall in the economic growth of the United States. Burry has noted that the interest rate used to be much higher in previous decades, and that a rate that is comparable to what was used in the past will eventually lead to a recession. Burry believes that the Federal Reserve will continue to raise interest rates because they're concerned about the increase in debt from the federal government. Burry notes that the federal government is spending hundreds of billions of dollars on debt servicing. Burry believes that the Federal Reserve will continue to raise interest rates until the federal government is forced to cut spending and/or raise taxes in order to pay down their debt. Burry believes that once the federal government is forced to cut spending and/or raise taxes, the US will enter a recession. So, what are potential causes of a recession? Let's begin with the housing market, as one of the biggest issues that could lead to a recession. Many economists and investors are worried that the housing market could lead to another recession. Michael Burry has suggested that a recession could be triggered by high inflation, which would cause the Federal Reserve to raise interest rates, which would in turn trigger a correction in the stock market. The rising cost of housing could also lead to a correction in the housing market, which could ultimately lead to a recession. If there is an increase in foreclosures, this would reduce the money available for people to spend in the economy, which could lead to a recession. A geopolitical event could also trigger a recession. In recent years, the US has experienced many geopolitical events, including the rise of China, trade tensions with China and other countries, the Iranian nuclear deal, the conflict in Syria, and tensions with Saudi Arabia. Oh, and let's not forget the Russia-Ukraine war old boy Putin started. These geopolitical issues could lead to a recession if they cause the US economy to slow down. A continued rise in interest rates could also lead to a recession, which at the moment seems like the way we're going. A recession is a period of economic decline that lasts several months or longer. The signs of a recession will vary depending on the cause of the economic downturn. It is important to note that there is no clear-cut signs of an impending recession. It is important to keep a close eye on economic numbers, especially in the housing market. There are certain signs to look out for that may indicate that a recession is on its way. If you see a combination of some of these signs, it could be a sign that the economy is in trouble and may lead to a recession. An increase in bankruptcies, an increase in foreclosures, an increase in unemployment, declining home values, a decline in consumer spending, an increase in bankruptcies, a decline in business spending, and a decline in government spending. The best way to prepare for a potential economic downturn is to be cautious with your spending. Be careful with your finances and try to save as much as you can. It is important to have a savings plan for unexpected events. If you have money saved, you'll have an advantage if a recession occurs. Generally, when a recession is looking likely, cash is king again. You can use that money to weather the economic storm and reduce the impact of a recession. If you're worried that a recession could cause financial hardship on your business, you should consider ways to reduce the impact of a recession on your company. Some options include reducing your operating expenses, increasing your revenues, and putting money away in a rainy day fund. Try to increase your company's cash flow by getting paid quicker from customers. This will provide extra cash that can be put away in a rainy day fund. Many corporate leaders, including Burry, Elon Musk, and Mark Zuckerberg, have sounded the alarm on the US economy as a toxic mixture of high inflation, surging interest rates, and slumping global growth threatens to cause a recession. Bank of America chief economist Michael Gapin also thinks that the US is headed for recession in 2023. In November of 2022, Jeff Bezos advised people to take some risk off the table, suggesting that slowing down big purchases and keeping cash on hand could make a difference for small businesses. The International Monetary Fund, or IMF, predicts global growth will slow to 2.7% in 2023. This is the weakest growth profile since 2001. The IMF also anticipates that global inflation has already peaked in late 2022, increasing from 4.7% in 2021 to 8.8%. Global inflation will likely decrease to 6.5% in 2023 and 4.1% by 2024. In terms of bond sales in 2023, the outlook is mixed. Interest rate hikes by central banks such as the US Federal Reserve, the European Central Bank, and the Bank of England have created a volatile financial environment. This has caused an increase in the yield of 10-year and 30-year Treasury notes, which has in turn caused a sell-off in bonds. This has been exacerbated by the rise in US Treasury yields, which have been driven by strong economic data and higher inflation expectations. The IMF expects global economic growth to decelerate over the course of 2023, and that the three largest economies, the US, the EU, and China, will continue to slow. This will have a knock-on effect on bond sales as investors look to more secure investments during periods of economic uncertainty. The IMF has also warned of a deteriorated economic outlook in its Global Financial Stability Report, citing tight labor markets in the US and UK as a potential risk to financial stability. In addition, the geopolitical tensions between Russia and Ukraine and the cost of living crisis in China has created a volatile period economically, geopolitically, and ecologically. This has caused further uncertainty for bond sales in 2023. However, the IMF has also noted that front-loaded and aggressive monetary tightening may be needed to combat inflation and stabilize the global economy. This could potentially lead to an increase in bond sales as investors seek safe haven investments. The IMF has suggested that fiscal policy should not work at cross purposes with monetary authorities' efforts to quell inflation. This could lead to an increase in bond sales as governments look to stimulate the economy and stimulate investment. Overall, the outlook for bond sales in 2023 is mixed. There are a number of factors that could lead to an increase in bond sales, such as aggressive monetary policy and increased government spending. However, there are also Michael Burry's predictions for the economy in 2023 have certainly sparked a lot of interest and debate. While some of his predictions may seem bold and even controversial, there's no denying that he has a track record of successfully predicting market trends. Only time will tell if his predictions for 2023 come true, but in the meantime, it's important to stay informed and make informed decisions about your investments and financial future. Remember to always do your own research, consult a financial advisor, and never invest more than you can afford to lose. Thank you for watching, and be sure to subscribe for more economic analysis and predictions. Stay informed and stay ahead of the game.